when investors tend to mix both approaches together when dealing with individual stocks. That means we pick and choose certain parts of the strategies to apply and certain parts of the strategies to ignore. That becomes a big problem in my opinion.
So is it actually possible to do both, or should we just choose one when we choose to invest?
So I would say that if you are devising your portfolio per se, right, I think it's perfectly fine to have a combination of value stocks and a combination and versus a growth stock, so that your portfolio is well balanced and not so lopsided to one extreme versus another. So when you're devising your portfolio, I think it's fine. However, I have this problem is when investors tend to mix both approaches together when dealing with individual stocks. That means we pick and choose certain parts of the strategies to apply and certain parts of the strategies to ignore. That becomes a big problem in my opinion. How do I mean that? For instance, value investors tend to wait for a big margin of safety. That means wait for a big discount before they enter. And when they enter, they buy and hold. Growth investors like myself, we are not so patient, right? We get into the stock at a premium. So when we get in at a premium, right, we should not be buying and holding because we are buying at a premium. And that's when investors tend to mix and match these strategies, right? They enter at a premium, and then when they are in the stock, when they're in position, they hold for a long time and say that, look, I treat it like I'm a value investor, but which you are not. So in fact, many people, when the stock price continue to come down, they average down by buying some more, meaning they use good money to chase after bad money. So this is the problem I have. So when you do that, you compound the situation, right? So you cannot be in denial. So growth investors like myself, we use a combination of technical chart versus the fundamental analysis to time our exit, right? The dot-com bubble, right, during the early 2000s was due to excessive valuation of this so-called growth stock. We must not forget the lessons of the past, right? The Nasdaq tanked over 70% when the bubble burst. Some companies disappeared altogether, right? Some companies, even great companies like Intel, for instance, right, has yet to recover above its pre-dot-com price until today, 20 years later. That's why it's very important that we manage our portfolio actively and use a combination of technical and fundamental analysis to make sure that we get out when things turn. So I would say that whereas whatever we practice, right, we have to follow through and make sure that we are consistent with the strategy. It's very, very dangerous to mix and match a strategy, right? That's where things can get very bad.
So that means it's actually imperative for us to choose the kind of strategy we want to adopt before we go in. Because if you already put in a buy and then you want to change your mind, or even after seeing the stock and then you say, oh, I want to change my plan, my strategy, it's going to be disastrous.
Yes, you're right. So when you change your mind halfway through and you throw the rule book out of the window, that's when investors get themselves in a lot of trouble, right? Like for instance, we know that when the growth stock is no longer performing well and the technical chart also says that as well, it's very imperative we do not continue to average down. Averaging down is the single biggest cause of capital burn for many investors in the past when they keep averaging down. Remember, growth companies have a life shelf. They do not continue to grow forever. That's the most important thing, right? Until some point in time, the growth will stop. And when the growth stops is when the stock get penalized a lot. That's why growth investors, we cannot afford to fall in love with any company. We know at some stage in the company life cycle, the growth will plateau and eventually decline. So the key is to identify when this happens and get out before the decline comes, right? So that's very important.